Welcome to Restructuring's third video series. I'm Jack Callow and I'm joined once again by Luke Venner. How are you today, Luke?
I'm very good. How are you?
I'm very well indeed, Luke.
Good.
Thank you for asking. Today we're talking about two topics. The first one being group reorganisations. Do you want to tell us a little bit more about that?
Sure. Yeah, sure. So group, we've spoken about, in separate videos, we've spoken about solvent liquidations as a tool for extracting your capital when, possibly you've retired or, you want to do something different. This is very much, again, using solvent liquidation as a tool, but for a different reason. So we see group reorganisations quite often, particularly with the bigger groups that we deal with, and this is all about an entity might have different areas of its business, or it could be different divisions, whatever, but they're structured through different limited companies, normally for commercial and risk reasons. What will happen from time to time, and you can come on to the reasons in a minute, but what will happen from time to time is one of those companies or a number of those companies might reach the end of their useful life.
Yep.
And there's then a question of, what do I do with it? Do I allow it to sit there and be idle, or do I go through a solvent liquidation process to actually get rid of it? The benefit of going through a solvent liquidation process is you're kind of cleaning up your group structure. So you're getting rid of companies that no longer have a purpose. So it's clean. Obviously, the more companies you have, the more compliance you've got to deal with.
Yep.
So if you're cleaning up your group, then you're minimising the time and the cost attaching to that. So it's a bit of a no-brainer. I think it's probably fair to say that you're reducing risk as well, because whilst a company remains live, it's susceptible to challenge, to issues with creditors, which obviously go away once the company is dissolved. That's not to say that a creditor can't restore a company, but it just it makes things a little bit more difficult. So I think they're probably the key reasons for tidying up a group structure. Really, there are tax reasons, in terms of moving assets and other bits and pieces around a group.
Yeah.
But normally it's around sort of cleaning things up.
Okay. So I think just for the benefit of our viewers, really, the most common example I see of group reorganisations is the bigger organisations which have multiple projects going on, and they'll set up an entity to run that project within, and when that project comes to an end, it just makes sense to deal with it there and then and move it on for all the reasons you just discussed there, Luke. The other common example I see is people on the buy and build strategy. Their objective is to bring businesses of similar trade together, bring them together within one shell, and then send them on in a sale of some description. That does leave multiple shell companies behind, which again, same principle. It's better to keep it clean, de-risk, and tidy it all up.
Definitely.
So shall we move on to the second topic or anything?
Yeah, and there's, I guess, one thing to add, if I may.
Please do.
And we've kind of covered this in a separate video, but I guess one of the key things and one of the key reasons that we get involved with the group reorganisations, and it probably comes back to the risk point, is whilst we might have a shell company, there's no asset in there. There's from a tax point of view, there's no real benefit, attaching to the solvent liquidation process. But the big groups, whether it's a PR point of view or I'm sure there are numerous reasons, but it's a good, clean way. And I've talked about being clean on a number of occasions. But if you're striking off a company, it doesn't give them that same protection that the liabilities have been properly dealt with. Whereas with a group, and bearing in mind that this is a group that's continuing to trade, albeit we're getting rid of a dormant company, it just provides some wider protection to the group.
Yeah, it's a great independence point.
Exactly. Yeah.
Absolutely.
Yeah. Sorry, you.
Yeah, no, I'm
subject.
just so keen to get to the second point. You see, I know it's such a good one to discuss. So, slightly veering away from the topic of solvent, I guess, because I'm going to mention loss making, but loss making divisions in the context of this series. What input would you add to that subject matter?
Okay, so I guess the reorganisation thing is quite relevant here, isn't it? But we will deal with companies that might have different departments or different divisions. Call it what you like, but different areas within the company, but it's all within the same entity effectively. You might have one division within that company that's performing poorly. Yeah. It might be that you've bought businesses over the years and one particular business hasn't quite worked out, a particular restaurant, for example, or a particular premises. The risk then is that the poorly performing area of the business brings the whole thing down, which clearly isn't good news if you've got a good, a good business otherwise. And it might be therefore that you're sitting on, an insolvent company by virtue of the fact that you've just got this one poorly performing area. So I guess the relevance of this is it's about, first of all, being clear on how the different areas of the business are performing, being clear on, where those different areas are going. And if it's necessary, you might need some tools, particularly around within the insolvency regime that can allow you to, effectively park the bad area of the business and allow you to continue working with the sort of the good elements.
So do you want to go in a few examples of those tools, or?
Sure. Yes. So I mean, it might be that you can sell the good elements of the business to a third party. It might be that with a bit of restructuring, you can just sort of close down the poorly performing areas and just keep the good parts. It might be that if you've got a company, and it's heavily insolvent, and the creditor's position is such that you can't continue to trade, you might need to look at things like company voluntary arrangements or administrations as a tool for protecting and rescuing a good business which sits within an insolvent company. It comes back to the point that we bleat on about. It's about getting the advice, isn't it?
Yeah, absolutely. Thank you very much, Luke.
You're welcome.
Thank you. So we're rounding off the series there, and I don't want to call it a glum note because it certainly isn't. It's a really important two topics on reorganisation and loss-making divisions. Keeping things clean, tidy, de-risking, and dealing with problems head-on is definitely the message here. Thank you for your insights, Luke.
You're welcome. Thank you.
And thank you very much for joining us.